For years, growth investing meant big tech. Now AI hype is cooling, volatility is back, and investors are rotating into energy, industrials, and consumer staples. So where can you find quality growth at the right price? Jacob Hemmer is Chief Investment Officer at SRH Funds. He joins us now. Jacob, great to have you here.
Yeah, thanks. It's good to be here.
So let's start with tech, because it feels like AI has gone from unstoppable to questioned almost overnight. How are you thinking about AI and tech investments at this point in the cycle?
That's a good question. It seems like everybody's got to have an opinion on AI. Is it in the early innings? Is it in the late innings? Are we maturing? Is there years and years of great growth ahead? At SRH Funds, we think we don't have to have an opinion on it. Kind of back to the old Warren Buffett adage that investing is it's like batting in baseball, right? You don't have to swing at every pitch. And in investing, they don't call a strike if you don't. So you can just wait for the pitch that makes sense, wait for the pitch you understand and you're confident you can hit. So yeah, AI is the buzz, it's the trend, it's exciting, it's going to be transformative, just like the internet was in the late 90s. That doesn't mean it's a great risk to take today, and it may be a wonderful investment in the future, but I don't think you have to know. I think if you do good investing, you can find other opportunities.
Okay, so you might not have to have the answers to all the questions at this point, because there certainly are a lot of questions. But how do you position within it as you think about growth at a reasonable price? Is the pullback that we've been seeing creating attractive entry points in quality names, or do you think that the skepticism that we've been seeing is actually justified and you need to find growth elsewhere?
I think there is a lot of opportunity in a lot of different places. One example lately is AI has been beating up the SaaS space, the software as a service. That may be a place where you can look for some potential growth opportunities if that disruptive technology doesn't totally destroy the industry. It's one of those questions, right? It's like, is it going to work? Is it not going to work? There are other places, though. Again, I think you don't have to be in the most competitive space. I think the smartest people in the world are trying to figure out if AI is working or not working. And there are other opportunities, like you mentioned earlier. Industrial is a good example. There's places that are coming off of low cycles, that have reasonable valuations, that present some interesting opportunities. And some of those companies can benefit from AI without sort of taking the capital risk that maybe some of the direct AI companies are in.
Okay, so let's dig into some of those opportunities, because investors seem to really favor stocks linked to kind of the physical world versus digital so far this year. We're seeing a lot of the AI immunity trade. You mentioned industrials, but specific names like Deere or Exxon or McDonald's, things that AI might not be able to disrupt. So are you in that pro-rotation camp? Where do you look when leadership broadens, if you could be a bit more specific?
Yeah, and one of the areas that we're interested in is trucking, for example. Trucking is something that got beat up. I think trucking was in a down cycle in the last few years. Things are starting to look strong. It's physical, it's necessary. It's also something that, with all the routing and logistics that's involved, it's something that AI could benefit without it being something that AI is going to replace, if that makes sense. That's an area that we feel like there's some potential opportunities in. Another one is we like looking at like the home builders, for example. Not just home builders, but stuff like that, where it's inexpensive because no one seems to be paying attention. And there's still a lack of housing in the country. So there's still a need, there's still demand, it's not going away.
Yet I'm taking a look at, so the fund that we're spotlighting here is the SRH Funds U.S. Quality GARP ETF, growth at a reasonable price. Taking a look at the sector breakdown, and I'm seeing that it's software and tech really at the top still. So you still want exposure there, but this provides diversification just away from AI.
I think the key difference is when we talk about quality growth. So quality growth, what we mean by that is we're saying we want growth that's sustainable, that's not a flash in the pan kind of company, kind of growth. It's not a overly cyclical. It's only on the growth side of the cycle, and it's not growth that is dependent on acquisitions. And so, yeah, there are some great tech companies, there are great software companies that can provide that kind of growth without it being something that feels overly risky. It's just a short-term trend. It's something that's not going to last. So there are plenty of opportunities still in the tech world, still in the software world.
Okay, so breaking it down by some of the biggest holdings, I see Ciena, so a software play, MCOR, Jabil, Enersys, Cardinal Health. I see New York Times on there. So not necessarily the names that we would have typically associated with growth. Is that because you think some of those big tech names aren't quality, or they're not a reasonable priced asset right now?
A lot of them, it comes down to price. Price matters. That's something that we've seen in the market. We've been talking about a lot internally is the large names, the large companies have gotten expensive. We see that in large caps in general. The large caps have one of the higher PE ratios, not that PE is the end all be all. It's not how we do valuation, but it's a good metric to look at. It's higher than it's been for a long time. And relative to some of these more mid-cap type companies, it's that gap in valuation has gotten really high. And so there's some opportunities in some of these smaller companies. I think that's one of the areas that is shining in our portfolio, is a lot more focus on kind of these medium-sized companies. Again, some of those are benefiting, and IMCOR is a good example. Some of those are benefiting from the AI trend. They're more of the picks and shovel type company than they are the gold, but if you can get it at a reasonable price, if you cannot overpay for it, that doesn't mean it's the cheapest thing in the world, but not overpay for it, we think that guards against too high of expectations, where you got to really hit it out of the park to keep the stock moving in the right direction.
Okay, so you've made the case for mid-cap over large cap. Make the case for mid-cap over small cap, though, because we have talked a lot about, so far in 2026, the small cap outperformance that we've been seeing with the Russell outperforming the Dow, NASDAQ, and S&P 500. Why mid-cap over small cap, though?
Yeah, I think it comes down to risk. Mid-cap, if you think about a medium-sized company, it's small enough relative to the large cap that it's not matured, which we've talked about. The growth potential's there. But relative to a small cap company, it's got balance sheet stability, it's got maturity, it's I think got a higher probability of surviving, especially if we go into a down cycle. And a down cycle could happen. I mean, I'm not predicting a down cycle, I don't know, but it could happen. And if it does happen, are the companies that you're invested in going to survive? I think that's a big question. And the mid caps, I think, have a better size, maturity, scale, better balance sheets to withstand that. It's sort of I like to think of it as you've got sort of the growth potential of these small caps with maybe less of that risk that the small caps might have.
So if it's mid caps that really have the compelling valuation and where you see the growth, what does that mean for the direction of the overall market then?
Well, it depends on what you mean by the overall market, right? I think if you're looking at some of these large cap indexes, anything can happen. Anything can happen in the next 6 months. We at SRH Funds very much have a long-term focus. When we're thinking about trends, we're thinking about 10 years, not in the next year, the next 6 months. And so anything can happen in the short term. I do think there's a relatively outsized risk, which you just don't have in the mid caps. And so the question that we ask ourselves is, we want to be in equities. We believe in the US, we want to be in the market, but do we need to take this outsized risk when we don't know if things are going to turn sour or not in the large cap, in the big growth names?
Okay, so how do you balance that, I guess, just to kind of wrap things up? Obviously, when I said the direction of the overall market, I meant what sort of returns can we expect to see this year? I wasn't meaning 10 years out. But you don't also want to miss out on any of the potential momentum there. So how do you balance risk with reward, quality at the right price with, not missing out on potential returns from areas that are beaten down now but might, lead the market higher later on down the road?
Yeah, I think looking at the beaten down areas is important to see if there are opportunities there, right? That's where taking that relative value, kind of saying, hey, is it a reasonable price? Is good? Is the growth sustainable? I think that in the near term, those returns could be strong and they could be sour. I mean, we've been very bullish on the market the last few years, and now we're saying, what's the question? What's going to happen? And I think the way you balance that risk is you go into these, like we've been talking about, go into these areas like mid caps or industrials, trucking, home building, where you feel like the risk is less. Feel like the outcome feels more, you're more confident that we can get positive, solid returns, even in the next year, in the next little while, because the valuations seem more appropriate for the growth profile that these industries, companies, sectors have.
Okay, we'll leave it there. Jacob Hemmer, Chief Investment Officer at SRH Funds. The ETF is U.S. Quality GARP, ETF SRHQ. Thank you so much for joining us. Really appreciate it.
I appreciate the opportunity.